Hello and welcome to Switzer Investing TV. I'm Peter Switzer, coming to you from Singapore today. On the program tonight, I'm asking the question, how come Wall Street went up when it got a massive jobs number? Usually jobs numbers up means inflation fears rise and interest rate cuts get delayed or might even become interest rate rises. But no, Wall Street went very positive and our market went up today as well. Then I asked the question, is Wall Street getting the lithium question wrong? Goldman Sachs thinks, oh, there's oversupply in the market, but there are others out there saying, no, it's not oversupply at all. It's got to even nearly a situation where there could be demand greater than supply. So lithium could be an interesting play going forward. Then BHP, Rio, and Fortescue, are they in the buy zone? If you believe China is really recovering better than expected, then the miners are looking like a decent play, as that also would help lithium as well. And finally, I'm going to ask my colleagues on the show, that's Paul Rickard from the Switzer Report and Jun Bei Liu of Tribeca Alpha Plus, what are their latest additions? What are the speculative plays that they like going forward? So that's the show. Let's kick off now with Jun Bei Liu of Tribeca Alpha Plus. Well, thanks for joining us, Jun Bei Liu.
Thank you for having me, as always, Peter.
Yeah. Now, the big question to me was, and it quite surprised me on Saturday morning when I saw that the job number in the US, 303,000 jobs created, and they only expected about 200,000. I thought for sure the market would go down on the fears of inflation remaining high for a long time and interest rate cuts delayed. How have you worked out why the market responded very positively to the number?
It's funny, isn't it? It all depends on how market feel at the time. And right now, the interpretation is that the market thought, even though it beat expectations, the job was too strong, but the velocity, or the delta of how quickly the job has been added has been slowing down. So net, people are saying, you know what? Even though it's a strong print, but it is slowing down. That is a great thing. And the new job being created is not as fast as it was. So so the call now net saying, look, we have 50-50 chance for a June cut at this stage.
Yeah. I also thought that there've been some people out there saying, oh, the US could go into recession. With a number like that, it really chases those pessimists out of the market. But also, we're looking at the March quarter profits coming up very soon. I guess if the job market's strong, you kind of expect US profits to be pretty strong, and they're pretty important to share prices, aren't? Profits are very important to share prices.
Look, absolutely. And, and the profit, if anything, does look like will be pretty strong based on what we have read from economic data. So, I do think the US economy is holding up well. Same as Australian economy is actually holding up a lot better than what people expected. So, and, if we do get a rate cut, it doesn't really matter if we get a rate cut in June or July or latter part of this year, but we will get a rate cut at some point. It is just to give a bit more confidence to the market that, certainly we're in much better place than we were 12 months ago.
This is going to be a hard one, and I'm not expecting you to be 100% correct on this one. But it just seems to me that since the pandemic, since the arrival of artificial intelligence, I'm wondering whether we actually can grow quicker than normal and not have the same kind of inflation. Because that seems what's happening at the moment. We're getting growth, but the inflation still is falling. And if economies change, it's those sorts of unusual outcomes can come about.
Look, I do think so because we're seeing the inflation falling because some of the issues previously we talked about was actually temporary. So your supply chain disruption, the border closure, and mobility for labor. Now it's all improved, and that's why we're seeing the inflation is falling quite rapidly. And of course, we're a little bit fortunate. China growth was a little bit slow to start, so that sort of didn't put too much pressure on the commodity prices. So everything together, certainly look like inflation's falling and the growth is holding together pretty well. And if anything, in the next 12 months, we're likely to see more fiscal stimulus, both in the US and here in Australia, to really support the economy. So, in a way, I think next 12 months for earnings, it does look pretty good.
Particularly when you throw in the fact that AI is, expected to deliver productivity, and if productivity delivered, we're talking lower costs, aren't we? So it could be a period of disinflation for quite some time.
Yeah, so that's the technological advancement that's coming through, right? So for decades, we actually literally had, technology deflation, and that has driven a lot of manufacturing efficiency and everything else. That's why we have consistently see the deflationary pressure throughout the decades. But the inflation that spiked in the last couple of years really seems to be temporary for most part of it. And now with the AI, and we certainly look like it is driving a lot of efficiency, there will still be a lot of, investment into that space. And, in this to start with, things will be a bit more expensive. But certainly, I think that technological sort of deflationary pressure will be there for decades to come.
Okay. Now, you've been arguing at least for 6 months, maybe a bit longer, that you thought China would recover. It's still a debated issue out there. I think there are more people supporting you now than there was 6 or 9 months ago. Um, what's your current reading? Do you think the Chinese economy is actually stepping up and improving?
Yeah, definitely. We are seeing improvement almost across everything now. So first quarter was a little bit slow, but we're seeing improvement now through, through a lot of demand for commodities and stabilization in some of those prices. We're seeing the consumer doing better. More recently, in fact, last weekend we just had the one of the long weekend for Chinese consumer, and then the travel stats is very strong. Domestic travel is now above the pre-COVID, so 2019 level. Even outbound from China is now just getting very close to the 2019 level. So these are very encouraging signs. And then we're seeing the commodity we talked to, which is iron ore, is now holding its level and looking a little bit stronger. I think over the next quarter or so, we will see this raft of activity in terms of investment in the, by the local government, because there was a bit of a delay caused by a number of issues, but now seems like those delay has been cleared, and that is coming through as well. So the growth we've been talking about, it is here. It's just took a lot longer to came through because the housing market certainly has put a lot of pressure previously, and now we are seeing a lot of other factors and now offsetting that weakness in China.
Okay. So on that basis, you brought iron ore up. Do you think that the big miners are in the buy zone as a consequence of an improving China and ultimately more demand for iron ore?
Look, absolutely. And I think big miners give you good exposure to many different interesting metals. So the likes of copper, at this stage, copper is actually very hard to come by in terms of equity investment here in Australia. One of the most, the most pure play is Samphire, and the valuation is very, very high. And so, if you buy BHP, who has quite a significant exposure, 30% copper exposure, with a much cheaper valuation, certainly I think the large miners is looking very, very well placed.
Okay. I guess I got to throw this one in because a lot of people are always interested in Fortescue because it falls the hardest and it rises the quickest. Would you be prepared to put money into Fortescue at this point in time?
Look, absolutely. This is actually my new ad in the last month or so. It underperformed quite a bit for the first quarter, and then we just saw opportunities that, the market was way too bearish, the iron ore prices, and we think the iron ore prices are holding pretty steady, if not going higher. So I think the Fortescue is the best pure way to play, I do think it will play a good catch up from here on.
So the question I was going to ask you about your latest edition, you already actually answered that question.
Oh, that's right. That's the one.
Okay, fair enough. And it's got some upside there if you're on the money. One final and related question on the subject of China and lithium. Now, I know you've you've seen lithium as a play that eventually will pay off. Um, is China an important contributor to the demand for lithium? Because my reading is that supply is starting to improve. There's gross oversupply. There's now a debate about whether that supply is getting close to balanced. But demand's really important to what happens to the price of lithium. What's your take on the demand coming out of China and demand for lithium just generally?
Yeah, look, I think the demand is China is a significant contributor. I think China is something like 20-30% of that demand for EV globally. And because it's been slow in the last few years, it's delta. So its pickup in growth is going to drive a lot of demand. EV demand is still in the double digits, which and the demand for lithium is still in the double digits. The problem was really just a bit of overstock and oversupply. And now it seems like it's really stabilized and the price is stabilized for lithium, and then the oversupply has now sort of cleared. You're quite rightly to say that a lot of mine has now been deferred. So quite a lot of supplies come out of the market when the demand is just on the cusp of improving. So we do think the lithium is looking pretty good at this stage. And of course, at this point, we certainly want to sit in the more cash generative ones, the ones that's making money at the current spot. The likes of your Pilbara, where it's still got billions of dollars of cash sitting on the balance sheet. I think it's pretty well positioned.
Yeah. What about IGO? That was mentioned recently by ethical partners. They
Mm.
think it looks pretty good. What's your take on IGO?
Yeah, look, I think IGO is good. The only thing is that there will be a bit of a delay in terms of how quickly they can get higher prices because their prices it's all contracted and because they jointly own one of the highest quality mine and low cost. But because price is contracted, when the spot price started running, they won't be the immediate beneficiary. But in time, say 3 months or 6 months, it will start benefiting from it. So I think it is a defensive play. It has underperformed the Pilbara. But look, I'm just much prefer to be in that pure play, the way they own their assets as well.
But is a part of your interest in Pilbara also it is the most shorted stock? So when the attitude changes to lithium, it'll be the one that will probably spurt the highest on the squeeze play.
That's right. It's quite incredible to see 20% of the register is short. So clearly, these short sellers have very high conviction that share price is going lower. When it doesn't, on the other hand, when the share price started going higher, like what it's been doing the last month or so, it will put a lot of pressure on the short seller. And eventually, they will be forced buyer of this company, when the share price continue to move higher.
Yeah, one thing I picked up during the week, I don't know whether you saw it as well, but both Hyundai and Kia are building EV cars in the hundreds of thousands. And so I'm thinking to myself that as you build every one of these cars, you have to have lithium batteries in those cars, don't you? And
That's
so,
right. Absolutely.
yeah.
Yeah. You
So
need battery. You need battery. And at the moment, there's no technology to really replace lithium ion battery. There's a couple of alternative technology, but they're not good enough for cars. They don't have enough power. They don't last enough. So we just within next decade, we just don't have anything to replace it. And with the demand for EV growing at double digit, it's we need batteries. We need more batteries.
yeah, and it just seems to me that if they're producing cars like there's no tomorrow, they'll want to sell those cars. So we may well see prices coming down. We will probably see massive advertising programs and all that sort of stuff. They'll be trying to make people get into EVs, and that's going to ultimately be good for lithium.
That's right. There will be incredible amount of demand. So lithium, also copper, and a couple other metal, but these are the two key ones that should really investor look to play.
Okay. Thanks for joining us. See you in a couple of weeks' time.
Thank you for having me.
And that's the show for anyone who's not a member of the Switzer Report. If you want to see the full show, we'd love you to become subscribers to the Switzer Report. go to switzerreport.com.au, and you will get some insights that you won't get if you're not a member or a subscriber to the Switzer Report.